Okay. So we always get a lot of questions from everyone about different topics. So today we're going to address some of those topics. So Scott, I'm going to ask you a few questions and let's go. So one of the questions
Sounds
that we
good.
always get asked is, what do you need to qualify for a home loan in Colorado?
Um, Whether it's Colorado or anywhere else for home loan, you're going to need to have a credit score, in most cases, income and assets. We do like to say if you have income, you don't necessarily need a lot of assets, or if you have a lot of assets, you don't necessarily need income. But either way, you're going to need a combination of a down payment, income to be able to show that you can pay the bills. Um, that's generally the case. We do have some other kind of loan types that don't necessarily have to have all those same requirements, but the majority of the loans we do, you have to have income and assets.
So as a business owner, we often get the question also from other business owners of, what if I haven't filed my taxes? Can I still qualify for a home loan?
Actually, yes. So if you're a W-2 employee, many times you can qualify just based on the W-2. And you didn't necessarily have to file taxes. Sometimes we do have to find a particular lender that has an appetite for that. But if you haven't and you're a business owner, there's different ways of doing it. Most loans are going to require tax returns, but we also have what we call bank statement loans, which is where we take income from bank statements and we derive income from that and an expense ratio. And many times, someone who doesn't necessarily have a lot of income on their taxes can qualify for a loan just using bank statements.
So as business owners, obviously we try to write off as much as we legally can. So this would be an avenue for other business owners as well.
Yeah, in fact, we've got a few deals working right now where some are in startup mode, some are heavily investing in their business, so they aren't generating a lot of cash flow into their personal accounts. So we do have ways of qualifying people that are self-employed and not necessarily claiming, or it's not that they're not claiming income on taxes. It's just the way accounting rules work. It doesn't fit in the same box as how mortgage rules work. Sometimes they don't always align, and we have products that help people when those things don't align.
Okay, perfect. Next question. Let's see. How much money do you need to make to buy a house today?
So this is going to be specific to the Denver area or Denver, Colorado Springs area more because it's really what your local market, what the houses are worth, what your income is, different expenses in different places. In the Denver metro area, you're going to need to be making probably north of $60,000 a year to qualify for a more or less an entry level house. And the reason for that right now is it's a combination of interest rates and housing prices over the last 4 years, pretty much since COVID. Housing prices have almost doubled in a lot of places, so the income has to be higher.
Talk to us a little bit about how we calculate income, like quick math.
Um, so for qualification purposes, typically what we'll do is we'll take somebody's gross income. That's the income before taxes. Everyone knows what they get on their paycheck, but they don't necessarily know what they get before all the taxes. So you'd want to look at a pay stub and see what your gross income is. Same thing for business owners. You'd have to go to your tax returns if we're doing a standard conventional FHA or VA loan and look at your gross income and figure out a monthly amount for that. So, for example, let's say you're somebody that makes this $60,000 a year. That's $5,000 gross. What we do is we take 50% of that. And again, this is very rough, but 50% is the upper threshold for how much someone's allowed to borrow from lending guidelines as a rule of thumb. And so we're at 50% debt to income that way. So that's 50% of your income. That means all of your debts have to fall under that 50% number. So we're looking at $2,500. If you have no other debt, then you can qualify for a $2,500 house payment. But let's say you have a $500 car payment. Now you can only qualify for a $2,000 house payment. And I'd say right now our average first-time home buyer in Colorado is spending north of $25,000 to $3,000. So it gives you an idea of what how we qualify and how much income somebody needs.
Perfect. Okay, next question. What credit score do I need for a good home loan?
So that's kind of a loaded question. The better your credit score, the better loan you're going to get. But that doesn't mean that you can't get a good loan without a great score. So for example, conventional will go down to 620. If you're putting 20% down, that may or may not be a good avenue. FHA has a minimum score of 500. That being said, if you're below a 580, you have to have at least 10% down. And then VA has no minimum credit requirement. You just have to be credit worthy. So that becomes an underwriter discretion kind of call. So probably the short answer is if you're above a 640 or a 660, you're in pretty good shape. If you're below that, you really want to talk to a loan officer, preferably us, to see what programs are available for you, which ones are less expensive. A lot of times a lower credit score might be really, really expensive on conventional and a lot less expensive on FHA. So if you're only looking at conventional rates, FHA is a really good opportunity for people that have lower credit scores.
Perfect. And a lot of times, if we get a phone call where somebody's not quite ready today, we educate and advise on what's going to get them mortgage ready.
Absolutely. And it doesn't, just because your credit's not there today doesn't mean that it can't be there very soon. There are opportunities also to rescore people's credit. So sometimes paying down some debt can take your score from say a 660 to a 700. And we have a program that analyzes people's credit and determines what's most likely to get their score up to help them qualify for a better mortgage.
Perfect. Perfect. What would you say is the easiest type of mortgage to get approved for?
Probably another loaded question. Ease of a mortgage all depends on your credit score, how much down payment you have or equity you have, and your income. So the easiest loan is the one that fits your particular situation the best. Sometimes that could be a conventional. If you don't fit in the conventional box, though, FHA is a really good option. And then we have some extremely easy loans, but they don't necessarily have the best rate. For example, we have a no questions asked loan. If you put 25% down and your score is above a 680, you can qualify for the loan. Technically, that would be the easiest, but that interest rate's 2 to 3% higher than what we're seeing in the market today. So it's not necessarily the easiest mortgage. We want one that's fine-tuned for your particular situation.
Awesome. Okay. We often get this to what lenders typically have the lowest rates? Like, is it, go ahead.
Go ahead.
No, go ahead.
Finish your...
I was going to say, is it brokers like us? Is it a credit union? Is it what we call a big box lender, like a Quicken or a Rocket?
It depends. Many things depend on that. Some lenders, for example, I just said that FHA will go down to a 500 score. If let's say you're at a 590, only a handful of lenders are even going to want to touch that loan. Doesn't mean it can't be done, but you may call a lender that can't even do that loan. So the rate's pretty irrelevant at that point. A lot of what determines rates is determined by a particular company's appetite. So what we call a big box lender or a bank depends on if they want to be aggressive on their rates and pricing or if they don't. Many times they're going to be very conservative, just in case they got to accommodate for loans that go sideways or that where people don't pay. So a lot of times they're less aggressive. Sometimes they're more aggressive, but typically those lenders, the big box lenders and banks, are quoting off of one rate sheet. Since we're mortgage brokers, we have several. I mean, we can look at 100 different companies' rates, but typically we tend to look at 10 or 20 different companies' rates. And those banks are all competing for our business. So while one lender might be really low price today, they may not be low price next week. So to be able to compare a bank, union, or a mortgage broker, you really have to look at the same time, within the same time block, definitely on the same day, because rates change daily and multiple times a day often.
And then what do you look for? Obviously, we get a lot of people that do shop for their mortgage. What are some things that people need to look for when comparing two different lenders?
Probably the big thing, well, the first thing is you need to get along with the person you're going to work with. So a lot of people start just calling around, and the one question they ask, which is, I mean, it makes sense. That's what anyone's ever been trained to ask, is what's your rate? What doesn't get factored into that is what are the costs for that particular rate? We have a saying in our company is you can have any rate you want. It just depends on whether you want to pay for a lower rate or have a rate that costs less money. So typically a lower rate's more expensive and a higher rate is less costly. But when you're comparing, what'll happen is you'll run into a lot of different lenders that'll have a low rate, but then they have sometimes several $1,000s of fees added into it. So the rate looks low, but the fees are high. And a lender like us, we can kind of break that up and explain the difference between the two and show you the true cost. Also, if you're looking for a low rate, that low rate is less important the shorter you're in the loan. So if you were really getting a 30-year loan and you're going to pay it for 30 years, that's where the low rate comes in. But let's say you're buying a house today and it may not be your forever home, or with today's kind of elevated rates, you're thinking, I'm going to buy it today and I'm going to refinance sometime in the future. You may not want to start out with the lowest rate today. It goes back to that, what I just said is that lowest rate costs more money. So what we do is we do a time analysis to determine over the amount of time that you're going to have a loan, uh, what's kind of the sweet spot of the lowest rate and the lowest cost, and work that into your personal plan. So we really do personalize that for a client.
Perfect. Well, I am out of questions. Do you have any others that you can think of up the top of your head that we get asked frequently?
I think the big one right now for me is it a good time to buy? Um, and like I try to tell people, well, first off, it is market dependent. There's some markets in Texas and Florida right now, they're getting really hit hard and unable to, the property values are dropping. We're not really seeing that in Colorado right now. It also depends on what your time horizon is. If you want to buy a place and live there for 6 months, then I wouldn't recommend buying a house at this time. It's You're not going to be able to buy something today and flip it in a few months and make money on that. So, kind of like a stock, if you have a buy and hold philosophy, now's an excellent time to buy. Um, Rates are high, property values are up, but everything that we're seeing or what we've been told is rates are going to be dropping. And when rates drop, more and more people are going to be coming into the market. As more and more people come into the market, the shortage of homes that we already have is going to drive the price of homes up. So while you
Mm-hmm.
may save a little bit of money on your interest rate, you're definitely going to pay more for a house.
Agreed. And with rates being higher, we're not seeing the bidding wars that we've had in the past.
Absolutely. I think this year is going to be like the last couple of years. Going into the fall, things cool a little bit because everyone's back in school. And the people that buy between September, October, November, December tend to get better deals than people that buy other times of the year. Does it mean values are dropping? Prices may drop, but that doesn't necessarily mean people lost money on the house. So as we go into this fall, I think this is probably the best time there is to buy because you're taking advantage of rates that have recently dropped,
Mm-hmm.
and you will hopefully take advantage of people that are wanting to sell and are willing to negotiate more than they would say during the springtime home buying season.
Absolutely. Anything else you can think of that we
Not
didn't
off the
talk?
top of my head, but that's what we've got right now.
Okay. Well, thanks for joining us.
Thanks for having me.